Hello and welcome to our show on financial investments. Today, we are going to talk about a mid-cap investment opportunity that has caught the attention of investors. It is the SPDR S&P Midcap 400 ETF Trust, commonly known as MDY. MDY is an exchange-traded fund that invests in the S&P Midcap 400 index. It was launched in 1995 by State Street Global Advisors and has since become one of the most popular mid-cap ETFs. Today, we are going to discuss why MDY is a good investment opportunity, its pros and cons, and how it compares to other mid-cap ETFs. Let's start by understanding what a mid-cap company is. A mid-cap company is a company that has a market capitalization between $2 billion and $10 billion. These companies are smaller than large-cap companies like Apple, Amazon, and Google but larger than small-cap companies like penny stocks. Mid-cap companies are known for their potential for growth, which makes them an attractive investment opportunity. One of the benefits of investing in MDY is that it offers diversification. The S&P Midcap 400 index includes 400 mid-cap companies from different sectors like finance, healthcare, technology, and consumer goods. By investing in MDY, investors get exposure to a broad range of companies from different sectors, reducing the risk of concentration in one specific industry. Another benefit of MDY is its liquidity. Being an exchange-traded fund, it is traded on major stock exchanges like the New York Stock Exchange and Nasdaq. This means that investors can buy or sell shares of MDY at any time during trading hours, unlike mutual funds, which can only be bought or sold at the end of the trading day at the net asset value. One of the disadvantages of MDY is that it has a slightly higher expense ratio compared to other mid-cap ETFs. The expense ratio is the fee charged by the fund manager for managing the ETF. The expense ratio for MDY is 0.23%, which means that for every $1,000 invested, the investor pays $2.30 in management fees. However, this expense ratio is still lower than many actively managed mutual funds. Another disadvantage of MDY is that it has a relatively high turnover ratio. The turnover ratio is the percentage of the portfolio that is bought and sold within a year. The turnover ratio for MDY is around 20%, which means that 20% of the portfolio is bought and sold within a year. High turnover can result in higher transaction costs, which can erode the returns. So, how does MDY compare to other mid-cap ETFs? One of the most popular mid-cap ETFs is the iShares Russell Midcap ETF, IWR. IWR invests in the Russell Midcap Index, which includes 800 mid-cap companies. The expense ratio for IWR is slightly lower than MDY, at 0.20%, and the turnover ratio is also lower, at around 11%. However, IWR has a slightly lower dividend yield compared to MDY. Another popular mid-cap ETF is the Vanguard Midcap ETF, VO. VO invests in the CRSP US Midcap Index, which includes around 350 mid-cap companies. The expense ratio for VO is the lowest among the three, at 0.04%, but the dividend yield is also the lowest. The turnover ratio for VO is around 13%, which is higher than IWR but lower than MDY. In summary, MDY is an attractive mid-cap investment opportunity for investors who are looking for diversification and liquidity.